In the previous week, the rupee was volatile and registered a low and high of 74.5900 and 73.8475 on 11/11/2021 and 9/11/2021 respectively. RBI's buy-side intervention prevented the rupee from rising above the 74 level on a sustainable basis. Dollar demand from importers and oil companies led the rupee to trade lower, much above the 74.40 level, and the domestic currency ended the week at 74.43. In the early part of the week, rupee was trading with a firmer undertone against the dollar as private and foreign banks were selling dollars for overseas investments, raising funds through IPOs. The rapid rise in the rupee below the 74 level so soon was unexpected by the market in the background of rising global oil prices. But the rupee's rise was altered by exporter selling and intervention from RBI. Due to cut in central excise duty, the prices of petrol and diesel has seen a drop of rupees 5 and rupees 10 per litre respectively. It is up to the state governments to decide on the adjustment in value added tax to further reduce the pump prices of petrol and diesel by rupees 4 and by rupees 7 at the maximum, leading to an overall reduction in petrol prices by approximately rupees 9 and diesel prices by rupees 17 approximately per litre. The approach to be finalized by the various state governments in reducing the VAT will be made more clear in the coming days. Due to reduction in the prices of petrol and diesel, after recognizing the reduction in VAT by the states, the headline number of CPI inflation may drop by 20 basis or more on an estimated basis, which also includes the indirect benefit accruing as a result of significant drop in the petrol and diesel prices. As a result of fuel rate cuts, the fiscal deficit target may exceed 6.5% of GDP, but well below the fiscal deficit target of 6.8% set by the government for the current financial year. Rupee is now trading with a weaker undertone as US inflation grew 6.2% year on year and 0.9% month on month in October. The US inflation was at a 31-year high, kindling fears of interest rate hikes in US immediately after the completion of tapering of Fed's asset purchases by June 2022. Chinese factory prices deepened concerns over higher inflation globally, which could lead to interest rate hikes by major central banks. But the dollar inflows from IPOs and other fundraising round of a few technology startups may not allow the rupee to weaken beyond the 74.80 level up to the end of this month. In the last 3 to 4 days time frame, we have continuously highlighted our recommendation for the importers to hedge their short-term payables spread up to 3-month maturities, as the rupee is expected to drift lower due to intervention from RBI. We understand that many of the exporters have covered their medium-term export receivables at close to the forward exchange rate of 76.00 or better. The unhedged export receivables, if any, is strongly recommended to be hedged at a spot target level of 74.80 plus, which can be seen after the dollar inflows recede over a period of time. Combined with the higher forward dollar premium available for medium-term export receivables would be attractive. The forward exchange rate would be attractive to enhance the export realization. After witnessing a deluge of dollar inflows coming into the market, RBI has started adding dollars to the reserve kitty as the exchange rate at close to the 74 level seems favorable for their book. More so, the central bank may prefer to maintain a competitive exchange rate to encourage export growth in the economy given the scenario of higher oil import bill and a rise in non-oil imports due to a sharp rise in commodity prices globally. Till the end of December 2021, we expect the rupee to trade in the range between 74.00 to 75.20 with a weaker bias. Due to higher inflation in the US, we are expecting to see a stronger dollar against the majors and Asian currencies, including the rupee. Instead of keeping the payables or receivables as unhedged, it would be prudent to hedge the exposures by choosing an appropriate spot level between the anticipated range suggested above. Barring any unforeseen events and adverse external developments, we expect the rupee to end the current financial year at close to the 76.00 level, registering a depreciation of less than 3.50% on an annualized basis over the translation rate of 73.50 as of 31/3/2021. US yields jumped overnight due to biggest annual gain in US consumer prices in 31 years and a weak 30-year bond auction. The 2-year yield, which typically moves in step with interest rate expectations, had its biggest up move and trading at 0.5054%, highest level since March 2020. The 10-year US yield also jumped to the current level of 1.57% from a low of 1.4150% registered on 9th November 2021.